Hello everybody. So today I wanted to give an update on FIGS. So I typically don't pay much attention to the actions of super investors, but Ron Barron I followed for a long while because of his investment in Tesla. He's one of the most famous backers, investors of Tesla out there, along maybe with Cathie Wood, except he got into Tesla earlier than Cathie Wood. He got into Tesla 8 years ago, and so in his investment in Tesla went for 400 million to 5 billion. And he has a very interesting style of investing, really strong growth, but also wants profit potential. He's invested in SpaceX, right? He has about a 1% of SpaceX, but another 100 million in SpaceX recently. Vail Resorts is another company that he backs, which actually, for this channel, I wouldn't be interested because it's not, hyper or super high growth, which is the type of stocks I cover on the channel. But, you can't remove the fact that, it beat by 1%, it beat the NASDAQ, which is very impressive, one of his overall holdings. This man right there is used to roller coasters. And so FIGS definitely fits the definition of a roller coaster, but he put $100 million before FIGS. And when I say FIGS is a roller coaster, is they kind of provided a poor quarter last quarter for Q1, and so the stock is back to all-time lows at $6.70, which means that if it were to go back to its IPO level, right, or to its all-time high, that would be 67 times upside compared to where it is today. So nice potential baked into that stock. But what happened? Why did FIGS go down? And it's noteworthy to say I initiated just a very tiny position in FIGS right after I made that video, and I probably have like 5% of a full position in FIGS. So of course this is becoming more interesting to me because I'm not down anything really. It's just 5% of a position, and I'm thinking about should I add more now that it's down? Kind of the goal of this video. So let's just explain quickly why it's down. Why is FIGS depressed right now? Why is the stock down? Well, first of all, they had a decent 2022. 21% revenue growth is what they had in 2022, and that's logical because they had a big slowdown in healthcare compared to 2020 and 2021, obviously. But the guidance was bad. Their guidance was they expect plus 5% growth, right, in revenue in 2023. Is it mid single digit growth? So I'm assuming it's a 5%. Could be as high as 9%. But they essentially gave very poor guidance, right? They're telling us it's not going to be double digit, although they gave pretty satisfactory adjusted EBITDA margin guidance. But if you follow this channel, I really don't care too much about that. By the time stocks become highly profitable, I want to be out of them and go into new growth stocks. So, but anyways, that's nice, right? For the market, that's nice. But the growth, like the growth in revenues is what was disappointing, and I think it's one of the major reasons why the stock is so down. And so, I do want to talk about this deceleration, and really I would like to dissociate it from the current macro crisis we're going with of 2022 and 2023, because I do think this is a company that is having really tough comps, right? Really tough comps, because if you think about 2020, 2021, you had a lot of people in the healthcare sector, had extra hours, had raises, spent more time at the hospital, which meant that they probably needed to exchange and change and buy new scrubs more often, and so right now there's a major slowdown as people are going back on breaks, holidays, getting back to normal. So we have this deceleration that is perhaps even more pronounced in healthcare right now, just because of the idiosyncratic nature of what happened in 2020. But I believe this slowdown in healthcare is temporary. It is temporary because the reason why I have healthcare stocks in my coverage is because I believe that healthcare is a megatrend, and it is linked to demographics. I focus a lot on technological trends on this channel, but demographics are some of the surest trends out there. And so what is one trend? Well, the population over 65 will grow by about 25% across the next 10 years. So if you look, like right now we have about 55 million right? And we are going to be in the 75 to 80 million people that are going to be more than 65. So that's a major increase, right? And we can see that the number of young people is really not increasing much at all, right? It's just close to the birth rate. But the number of older people is really, really increasing. And of course, when you get older, you have more procedures done at the hospital. And so that's why I believe it's a major mega trend. These people who are turning 65, they're going to have greater healthcare needs, and they're going to have to go in the hospital to get those needs. And so how do you capitalize on that trend? Demographics, is destiny. It's one of the surest trends out there. Well, you could invest in nursing homes, but, REITs don't have very high returns. You could invest in drug makers, but I believe drug makers are oftentimes subject to disruption, and there's a lot of slower growth sometimes among growth makers. They tend to be more value stocks often, and so I believe as a growth investor, I believe the best way perhaps to have exposure to this is to invest in for example, HIMSS, right? HIMSS would be an example of a company that's more a blue ocean type of company in the preventative healthcare space, right? Trying to create a consumer brand. Or you could invest in what I call the picks and shovels, which is, there's going to be a gold rush, right? More and more nurses, more and more doctors are going to be working in this field because of the aging population, and you could sell them the picks and shovels for that gold rush. And those picks and shovels in that gold rush are what? It's the scrubs. It is what you wear in an hospital environment or in a medical environment. You wear scrubs. That's the outfit. So just like jeans were sold during the gold rush, and actually Levi's was one of the richest enterprises selling jeans instead of looking for gold, well, maybe if you sell outfits to the healthcare professionals, you're going to take advantage of that boom that is coming in healthcare because of the inevitability of the aging baby boomers. And so I believe that's one of the reasons why someone like Ron Barron is behind this stock, and that's why I'm interested in the stock. Let's quickly talk about how cheap this stock is. And after the recent drop, right, more than 20%, this company has gotten really cheap now. It's only trading at 2.5 times sales. They have no debt, virtually no debt, right? Some leases, but nothing noteworthy. And they're valued at $1 billion in enterprise value right now. Exactly. And so right now, of course, they've guided for about 5% growth. I took the midpoint. That would not be a cheap stock in my guidance, because I look at how much am I paying for each percentage point of growth. But look what happens if you just increase the growth not by much. Like if they go back to 20%, they are in the top 5, actually top 3 cheapest stock in my framework if they go back to 20%, right? And if they go to 30%, they suddenly become the cheapest stock in my framework. And so that's the question that one has to ask themselves when they invest in FIGS. Do they think FIGS can turn around as soon as we normalize, as soon as we move away from these tough comps? Can FIGS turn around and get back to 20 to 30% growth? If it can, I believe the value of that stock will re-rate. That's what I believe. That's why I'm planning on increasing my position and walking maybe towards half a position until we get to the next quarter of FIGS. So what else? What else can I say about how cheap this FIGS? So as I said, it's 2.5 times sales, which is very cheap. Gross profit. This is a company that has a 68% gross margin. This is pretty high for clothing. Clothing is a high margin product, right? It's not quite SaaS software, but almost as high as SaaS software. Their enterprise value to gross profit is 3x, right? And even if you were more of a traditional investor who looks at your cash flow yield and all of that, well, assuming they do only 5% growth in 2023 and they have a revenue of $540 million. Think about it. $540 million worth of scrubs. Their adjusted EBITDA would be $52 million, which means that the company right now is trading at about 20 times next year's adjusted EBITDA. Now, keep in mind, like a lot of people, I realize that for mature companies, I don't like adjusted EBITDA. But for a company like FIGS, I don't have a problem using adjusted EBITDA because it's going to be very close to cash flow for FIGS because they don't have very high tax expense, right? They're not showing that much earnings right now, and they have very little interest to no interest because they have no debt, right? So they actually pay very little in interest rate on the teeny tiny bit of debt that they have. So that number, I think is okay for FIGS to use. Obviously, that number makes no sense to you if you're like a utility. Like that makes no sense to you because you have all of this debt. But for a company that has no debt, adjusted EBITDA is fine. And so that would be a juicy valuation, I believe, even for a value or next to a value investor. Isn't that interesting? Therefore, that's why I like the stock. I'm interested in the stock right now. Also, I'll also say this: the share count has been flat to declining, which is very rare. And if you watch the channel, I typically don't mind too much dilution because it's a way that companies don't go bankrupt, right? I like my companies to be anti-fragile. I like that they don't go bankrupt. But look at this. Aside from the last quarter where we increased shares outstanding a little bit, they've been on a decline. So there's been fewer shares. So this is a company that has been reducing share count, which is very rare at this stage of growth, right? So to me, this stock, FIGS, has some margin of safety baked in. Quite a bit, actually, at a price of $6.70 a share. To me, this is more of a tier 3 stock now that the growth has stalled. When I introduced the stock on the channel, it was more of a tier 2 stock. Now it's a tier 3. I believe the growth could be explosive, but I don't know when. Is it going to be 2024, or is it going to be 2023? Maybe. Who knows? I don't know when. And I also know one more thing that I like, and I want exposure to lifestyle stocks. I believe lifestyle stocks offer nice diversification to my portfolio. And my recent experience with Celsius Holdings, which I sold out very recently, really tells me that more lifestyle brands promoting a lifestyles and catering to a segment of a population that identify with that lifestyle, these brands can have very explosive, even surprising growth. And, of course, the companies that come to mind when I think about that are companies, for example, like Monster Beverage, companies like Lululemon. They've had explosive growth, which you cannot really explain by looking at underlying technology or even by looking at business model. You can only explain this type of explosive growth by looking at lifestyle and the marketing. Really, it's really the marketed segment that they've found in the market. It's really that segment that can explain the growth in this stock. So this is nice diversification. I believe FIGS is a lifestyle stock. It's catering to the healthcare lifestyle. And so, this is important to talk about this. Are scrubs the next big trend in clothing? I know that sounds far-fetched right now, but let me ask you this. Let's say in 2001 or 2002, could you have predicted that yoga specialized apparel would become a major trend? And that is exactly Lululemon. Like, let's not forget that the Lululemon clothes, like if you go to any high-end mall, you probably know what I'm talking about with Lululemon. It's very popular among Gen Z, among younger millennials. They're yoga apparel. People are wearing yoga apparel. People who have never done yoga at all. They're wearing and buying yoga apparel because it's a lifestyle brand. They like the idea of it, right? And so I believe scrubs themselves could become a lifestyle brand. Popular culture is headed in a way where I don't see why this could not be one. And of course, I pulled out the chart of performance of Lululemon here versus to Kohl's. Kohl's is kind of a your legacy clothing brand. Nothing too exciting. You can see that Lululemon had outstanding performance. Perhaps not as high as, say, a Tesla, but very, very, very satisfactory performance for, again, something as simple as clothing. So that's lifestyle for you. And again, I believe this could be possible, because when you look at these pictures, I suggest you take a look at their website and some of the products that they sell. I see a blurring of the line between workwear, scrub wear, and stylish apparel. I mean, quite frankly, half of these I wouldn't know that they're scrubs, and so this is probably what happened to Lululemon with yoga pants. Like it's like if it's say it's a scrub, yes, but if it's a scrub that you can wear outside of the workplace, just like yoga pants you can wear outside of a yoga studio, then you're creating a form of style that is based and rooted in popular culture. And of course, of today, popular culture, there's a lot of TV shows, a lot of social media that is around healthcare. You know, it's a field that has a very good image. It's a field that has a very good image that I believe a lot of people, younger people perhaps, are going to associate with. So again, maybe this is obscure to many of us today, but who knows? You don't know where trends are headed. And if it does, like if it does work out, and when I see the profits of Lululemon, you know, I'm like, this could be a really good stock to own, especially at this valuation. So, and you know, I do want to say that I understand that this opportunity is tough to understand. It's tough for me to understand it, actually, you know, but I do want exposure to a lifestyle brand. It's tough to understand because, as someone pointed out in my other video on FIGS in the comment section, they said, oh, you know, I wear scrubs at work, but you know, this is more something that's fashion forward women will do, and you know, they'll want the new colors and the new style, and they'll go ahead and buy it a lot. And of course, this almost makes me more bullish, because when I see, for example, the audience of my channel, let me share with you the audience of my channel in case you were wondering. It's let's round it. It's like 99. It's exactly. I mean, it's 99% men and 1% woman, and I am pretty sure I know one woman in there. So you know that if you remove the one I know, that's even less, right? So it's an opportunity that we're not equipped to see. Maybe we're not equipped to see this opportunity because the channel of the audience and a lot of the investing community actually is perhaps like that. If my channel is to be believed, actually I have a hard time believing these statistics actually. So maybe we don't see that opportunity, and if we don't see that opportunity, then we believe that this is the way that scrubs have always been sold and will always be sold, i.e. You go for the regular, so you always go for the baggiest type of clothing possible, and you buy it from, say, a clothing dispenser, or you use something that's provided by your workplace, essentially. So that may be what we're inclined to believe, because we do not operate in a fashion-forward atmosphere. But sure enough, you know, there's been a lot of brands and a lot of money that has been made in fashion. Like I said, you know, I would have missed totally Lululemon. I would have totally missed it. So, let me finish the video by telling you what it is that excites me, and what excites me about this stock, and why I think this stock could actually become big. Because even though they have guided down for their revenue in 2023, there's a few exciting things. So one of them to me is their international presence. I just want to say that they have I mean, it's kind of you know, funny that I call it proof of concept, because they're way beyond that, right? They have IPO'd. Proof of concept is more of a startup term, but they have more than proven that the concept works out in the USA. More than proven. And if you actually look up the 2015-2016 lawsuit that they won, that FIGS, Charismatic, which is the maker of apparel, Dickies Cherokee in the scrub space, is like the legacy leader. Charismatic sued FIGS to try to slow them down, and so a lot of the CEO emails leaked. And if you read those CEO emails, you actually realize that FIGS has tremendously hurt the sales of Cherokee, and they actually the FIGS people created a whole website about it, where you can actually look at that lawsuit and what happened, and what Cherokee tried to do, like 6-7 years ago, to stop FIGS. I believe that FIGS kind of created an earthquake in that space. An earthquake. You had an established brand with very, very strong moat who saw that moat disappear really, really quickly. So they have some proof of concept. And since they have that proof of concept, what we're doing now is that they're taking that proof and they're expanding it abroad. And it's very easy for them to expand now that they have, a business model that is set in stone. And they've identified 118 million healthcare pros to go after that are not yet exposed to the product. And so you can see many more countries, many more, especially European countries, right, they are going to grow quite fast, I believe. And in fact, their growth has accelerated. You can see they had 50% year over year in 2022, but their Q4 growth was 76%. So very high growth, I would argue, in the international market. And another one that I want to point out here, which is once again kind of the Lululemon playbook, is they are opening their first showroom, right? I call this more of a showroom, but it's a retail store. But they're opening their first showroom in a major mall in Los Angeles in Q3 of 2023. They will open that, and so what will that do when they open these stores? Typically, I would be against that. Typically, I would think it's a bad idea because it's very expensive. But I can't forget about this trend that we've seen over the past 3 to 4 years of a lot of online-only brands are able to pick up premium retail space, premium showroom, premium leases from struggling legacy retailers who are exiting. Malls are struggling, malls are dying, they're on their way out. And because they're on their way out, they are giving a lot of great deals to some of these retailers that are a little more exciting. And so could this be a way to further the brand awareness? Do not forget that when you shop for clothing, there is a large experiential component, and it's only limited the experience that you can create when you buy in an online store. For now, I mean, I believe over the long term it will get better, but it's still somewhat limited for now. So I would understand why they want to go into select retail, and clearly, to me, this company is on track. To me, as a thesis, this company's thesis is on track. The risk of this company has definitely increased because of that guidance being low in 2023. The risk has increased. But the stock price has been more than punished for that risk, more than punished. So this would nicely fit in the bucket: high risk, high reward. This is kind of a bucket where I would put FIGS right now. There's obviously much better opportunities in the stocks that I cover on the channel, obviously, but it's a matter of how diversified do you want to be. I like to have diversification, and I try to think of diversification in terms of sectors, and I need at least one lifestyle stock. I believe it's important to have an uncorrelated hypergrowth, right? Very uncorrelated hypergrowth that you can have in a lifestyle stock. This is a major trend of retail. And if you want to know more about my train of thought about lifestyle stocks and why I like to have one in my portfolio, I would recommend you watch the other video that I made about FIGS, where I go much more in depth as to how brands and how marketing is evolving from mass market, mass appeal brand to narrow market, narrow appeal brands that have much higher margins and are able to have much greater profits in the long run. So this was all for today's video. This is not investment advice. This is just entertainment. Thank you so much for watching. Appreciate your likes. Appreciate you subscribing. Thank you for your time and have a wonderful day.